Welcome to your channel name where we break down top tech stocks. Today we're diving into Synopsys, ticker SNPS, a leader in chip design software. With AI and semiconductors booming, can Synopsys hit $1,000 per share? In this video, we'll explore its pros, cons, financials, competitors, dividend policy, returns compared to major indices, and predictions for 2030 and beyond. Stick around for a full breakdown and let's jump in. Synopsys powers the semiconductor industry with its electronic design automation software, critical for AI, IoT, and more. As of September 2025, its stock price is around $604. Analysts see a short-term target of $662, but some long-term forecasts predict $980 by 2030, with a shot at $1,000 by 2027 if AI demand keeps soaring. However, its high valuation could limit upside, so let's weigh the factors. What makes Synopsys strong? First, it's riding the AI wave with its tools enabling complex chip designs. Its shift to a subscription revenue model ensures steady cash flow, and the $15 billion Ansys acquisition, set to close by 2026, will expand its portfolio. It boasts a solid 31% net profit margin. But there are risks. US-China trade tensions could disrupt supply chains, and competition is fierce from players like Cadence Design Systems, which has similar margins around 30% but lower debt levels. Synopsys carries $15 billion in debt, though its cash flows cover it comfortably. Synopsys' financials are impressive. Its net profit margin has climbed from 18% in 2020 to 35% today, showing operational efficiency. Debt stands at $15 billion, with a debt-to-equity ratio of 55%, but its $2.5 billion in free cash flow ensures it can manage this load. Side incomes, like investment or interest earnings, are minor and volatile, contributing little to the balance sheet. Since its 1992 IPO, Synopsys has delivered over 3,300% returns to investors, a stellar track record. Looking to 2030 and beyond, Synopsys is investing heavily in AI, multi-chip systems, and quantum computing. The semiconductor market is projected to hit $1 trillion by 2030, and Synopsys is well-positioned. Government incentives like the CHIPS Act will boost growth, but risks like export restrictions, geopolitical tensions, or supply chain disruptions could hurt. Socially, environmental regulations and ESG pressures may pose challenges, while workforce shortages could also impact operations. Synopsys doesn't pay dividends with a 0% yield, so it's not a dividend aristocrat. It's a growth stock, reinvesting profits into innovation. Performance-wise, it's a winner, up 25% year-to-date in 2025, beating the S&P 500's 11%. Over 5 years, it's returned about 200%, outpacing the S&P's 80%, Nasdaq's 150%, and global indices like FTSE 100 and Nikkei, which trail significantly. So, can Synopsys hit $1,000? It's possible by 2027, driven by AI and semiconductor growth, but high valuation and geopolitical risks are hurdles. Compared to indices, it's a strong outperformer, making it a compelling long-term hold for tech investors. What do you think of Synopsys? Drop your thoughts below, and if you enjoyed this, hit subscribe for more stock deep dives. Disclaimer: this is not financial advice. Always do your own research.